Imagine a multi-billion-dollar technology company where over half the code, like 57% to be exact, it isn't actually written by humans anymore.
Right.
It's written by artificial intelligence. And I mean, we are not talking about some experimental Silicon Valley consumer app that generates, funny avatars or something.
Yeah, no, definitely not.
We are talking about the invisible software layer that is literally holding up the global banking system.
It is a staggering metric.
Oh.
I mean, we are witnessing a fundamental rewiring of how enterprise software is built, and honestly, more importantly, how it operates inside these highly regulated industries.
Oh, absolutely.
And what makes this so compelling, I think, is that we get to see it play out not just in like visionary white papers, but in cold, hard, audited financial metrics.
Well, welcome to another deep dive. We are thrilled to have you with us today. Our mission today is doing exactly that, taking a magnifying glass to a company that is right at the center of this technological tectonic shift.
We really are.
We are breaking down the Q1 fiscal 2027 earnings call for nCino. And for those of you tracking the market at home, the ticker is nCino.
nCino.
Right. They are a profoundly important player in the fintech space, and we're going to put on our talk tickers hats today. We really want to cut through the corporate jargon, look at the actual data, and figure out exactly what this means for you, the retail investor.
Yeah, and to really grasp why this specific earnings call is such a treasure map, we first need to understand the environment nCino operates in. Because they aren't some flashy consumer brand, right? You aren't downloading an nCino app on your phone to split a dinner bill with your friend.
Right. They operate in the shadows. But they operate in the most critical shadows of the economy, if that makes sense.
It does.
Founded back in 2011, headquartered down in Wilmington, North Carolina, nCino is essentially the software as a service backbone for financial institutions all over the globe.
Yeah.
Think about the post-2008 financial crisis world. Banks were suddenly just buried under an avalanche of Dodd-Frank regulations.
Always a nightmare for them.
Total nightmare. Compliance requirements and this urgent need to track every single aspect of risk.
And historically, how did banks manage that risk? They did it with legacy on-premise servers.
The worst.
We are talking about literal green screen terminals.
Wow.
Endless nested spreadsheets, so much manual data entry, and just a small army of analysts whose entire job was simply typing numbers from one siloed system into another.
The friction there had to be immense.
Oh, totally. From the moment a commercial customer walks in the door to request a loan to the actual moment the funds are dispersed, there are dozens of touch points. You got customer onboarding, KYC compliance.
Well, your customer, right?
Yeah, exactly. Deposit account opening, and then, the incredibly complex underwriting process itself.
And commercial loan origination is notoriously brutal. I mean, you are dealing with complex corporate structures, varying forms of collateral, debt service coverage ratios.
That's a lot of math.
It's a ton of math. And nCino came into this environment and said, hey, we're going to take all of that fragmented chaos and put it into a single, unified, cloud-based platform.
Yeah, they serve as the system of record for the operational processes that actually drive the revenue and mitigate the risk for these banks.
And their client list spans the entire spectrum of finance, doesn't it?
It really does. They serve global enterprise mega banks all the way down to regional banks, independent mortgage banks, and even local community credit unions. Basically, if a financial institution needs to make a loan or monitor a credit portfolio, nCino wants to be the software running that specific workflow.
Which brings us to how we are tackling this today. We are going to take this talk tickers approach, which means we are keeping it data forward. We're translating the dense Wall Street accounting into plain language, offering an opinionated stance on the business, and most importantly, giving you actionable takeaways.
That's the goal.
We'll explore the headline numbers, unpack the underlying business model changes, decipher their management guidance, and then deliver a final verdict on whether this is a bullish or bearish signal.
Sounds like a plan.
Okay, let's unpack this. Let's start with the raw data, because nCino didn't just casually stroll past expectations this quarter.
Far from it. I mean, the Q1 performance was exceptionally strong across the board. Let's look at the top line first. Total revenue hit $159.4 million, and that represents an 11% increase year over year.
That's solid.
It is. But as seasoned software investors know, total revenue includes volatile items, stuff like professional services or one-off implementation fees. The metric that dictates long-term valuation is recurring revenue.
Right, the subscription revenue. It's the lifeblood of the SaaS model.
Exactly. And nCino subscription revenue reached $140.9 million, which is a 12% year-over-year growth rate. Now, what Chief Financial Officer Greg Ornstein pointed out, and this is a crucial detail for our listeners, is that this represented a significant sequential dollar increase of approximately $7.5 million from just the previous quarter.
Wow.
Yeah, quarter-over-quarter growth of that magnitude in a slow enterprise sales cycle that is a really strong indicator of accelerating momentum.
But top-line growth is only half the equation these days. We are operating in a completely different macroeconomic environment than the zero interest rate days of 2021.
Oh, completely. Those days are gone.
Wall Street has aggressively punished software companies that just grow at all costs while bleeding cash. What struck me about this transcript is that nCino is executing an absolute masterclass in operating leverage.
You really are.
Non-GAAP operating income skyrocketed 79% year over year to $44.5 million. And free cash flow surged 54% to $80.8 million.
And those leverage metrics demonstrate that as they add incremental revenue, a disproportionate amount of that capital is falling straight to the bottom line.
Right.
They're not buying their growth by setting, piles of venture capital on fire. And this leads us to a major financial milestone that management was extremely eager to highlight on the call. nCino has officially hit the Rule of 40.
Okay, let's pause and translate that. The Rule of 40 is one of those benchmarks that gets tossed around Silicon Valley boardrooms constantly, but we need to break down the actual math and why it dictates stock prices. Let's think of it like a physical fitness test for a company.
I like that analogy.
Yeah, it proves you can build muscle, which is revenue, while burning fat, which is maintaining high margins, rather than just eating everything in sight to get bigger.
Simply put, the Rule of 40 is a formula used to evaluate the health of a mature SaaS company. You take the company's revenue growth rate percentage, and you add it to their profit margin percentage.
Okay.
If the combined total equals 40 or higher, the business is considered an elite, highly balanced operator.
Right, because it proves a company has successfully transitioned from that chaotic, cash-burning startup phase into a sustainable, compounding business.
Yeah.
In the early days, you might have, say, 80% revenue growth, but negative 40% margins.
Yeah, exactly.
You still hit 40, but it's fueled entirely by outside capital. What the market demands now is balanced maturity.
And look at nCino's math this quarter. We have their accelerating subscription revenue growth of 12%. You add that to their non-GAAP operating margin, which reached an impressive 28% this quarter.
12 plus 28.
Equals exactly 40. They hit the mark by demonstrating they can sustain double-digit growth while operating with high profitability.
And a 28% operating margin is phenomenal for a company that is still heavily investing in research and development.
Oh, yeah.
And clearly, the executive team knows exactly how strong their balance sheet is right now because they are actively deploying that free cash flow to buy back their own stock.
This is perhaps the most actionable data point for a retail investor trying to read the tea leaves here.
Yeah.
During the first quarter, nCino repurchased 6.1 million shares of their own outstanding common stock.
At an average price of $15.20 per share.
Right.
That is a total capital layout of $93.1 million in a single quarter. But I want to dig into the mechanics of this because the transcript mentioned they use something called an ASR, an accelerated share repurchase program.
Yes, the ASR.
How does an ASR differ from a company simply logging into a brokerage account and buying shares on the open market?
It's a great question because the mechanics reveal a lot about management's urgency. In a standard open market repurchase, a company buys shares slowly over time to avoid spiking the stock price.
Right, like a slow drip.
Exactly. But an accelerated share repurchase involves an investment bank. nCino essentially hands a massive lump sum of cash, in this case, part of a $100 million authorization to an investment bank.
Okay.
The bank then borrows millions of shares from institutional holders and delivers them to nCino immediately, and nCino retires those shares right then and there.
So the share count drops instantly, boosting earnings per share right away.
Yes, and then the investment bank spends the next few months slowly buying shares on the open market to replace the ones they originally borrowed. For nCino, they received 5.5 million shares up front as part of the specific ASR, and they expect the final settlement of remaining shares in Q2.
Got it.
Additionally, they still have $65 million available for future repurchases under an older 2025 program.
So when an executive team chooses an accelerated share repurchase over a slow, open market drip, they are signaling extreme conviction.
Oh, absolutely.
They are effectively telling the market, hey, we believe our intrinsic value is significantly higher than your current $15.20 valuation, and we want to lock in the retirement of these shares immediately before the market wakes up and reprices us.
It is the ultimate corporate vote of confidence. But, a company doesn't authorize a near $100 million buyback just because they had one lucky quarter.
Right.
They do it because they fundamentally rewired their revenue engine. Which leads us to the story behind these numbers, specifically what's happening with their pricing model.
This is where we look under the hood. Earlier, we noted that $7.5 million sequential jump in subscription revenue. On the call, the CFO explicitly stated that while record gross bookings in Q4 definitely helped, a primary driver of that jump was the transition to their new platform pricing model, which resulted in straight-line revenue recognition.
Yes, straight-line revenue.
Let's define that accounting term for the listener. What exactly is straight-line revenue recognition, and why does it cause a revenue bump?
Well, to understand the bump, you have to understand the old model first.
Right.
For years, the standard playbook for nCino, and honestly, almost all SaaS companies, was seat-based pricing.
Right.
If a regional bank wanted to use nCino, they paid a license fee for every single employee who needed a login.
So you have 200 loan officers, you buy 200 seats.
Exactly. But the revenue recognition under a seat-based model is tied to the physical deployment of those seats. If a bank signs a contract today, but rolls out the software to different departments over a 9-month period, nCino can only recognize the revenue as those seats actually go live. It creates a really jagged, backloaded revenue curve.
Which is incredibly frustrating for investors who want predictable, smooth top-line numbers. But CEO Sean Besman realized that seat-based pricing has an even more fatal flaw than just unpredictable accounting, especially as we enter the era of automation and artificial intelligence.
It really does. It creates an active disincentive for building great technology.
How so?
Think about it. If nCino's software is incredibly efficient, like if their new AI tools allow a credit analyst to do the work of 3 people, the bank won't need to hire as many analysts.
Right.
The bank might actually shrink its headcount while growing its overall loan portfolio.
And under the old seat-based model, if the bank shrinks its headcount and nCino loses revenue, they would literally be penalizing their own top line for delivering a more efficient product to their customer.
Precisely. Management recognized this structural misalignment and executed a proactive pivot. They're transitioning customers from that fixed seat-based pricing to what they call an asset-based or platform pricing model.
Okay, let's break down the mechanics of asset-based pricing. How do they actually track this? Are they charging a percentage of the loan?
Not exactly a percentage of the loan, but rather pricing tiers based on the total volume of assets or total asset size of the institution flowing through the nCino platform. Because nCino is deeply integrated into the bank's core ledger via APIs, they have real-time visibility into the volume of commercial loans being originated or the total size of the portfolio being managed.
So they correlate nCino's revenue directly to the bank's operational outcomes.
Yes. And this is where the straight-line revenue recognition comes back into play. When a bank signs a platform-based contract, the total annual value is fixed based on their asset tier, regardless of how many individual employees have logged in on day one.
Oh, I see.
Therefore, accounting rules allow nCino to take that total contract value and divide it evenly in a straight line across the 12 months of the year.
So by shifting customers to this new model, they immediately pull forward revenue recognition that otherwise would have been delayed while waiting for individual seats to be deployed.
Exactly.
That explains the sudden $7.5 million sequential bump. But the long-term play here is even more powerful, isn't it? It builds intra-contract growth right into the DNA of the software.
That is the real prize. Under the platform model, as the bank grows its asset base, as it processes more loans and generates more revenue using nCino's tools, it automatically bumps into higher pricing tiers.
Wow.
nCino captures more value organically, without their sales team having to undergo the friction of calling up an IT procurement department to beg them to buy 50 more seats.
So if the bank wins, nCino wins.
Right.
And they are executing this pivot aggressively. As of the end of Q1, over 40% of their annual contract value, their ACV, has already transitioned to this asset-based pricing approach.
During the Q&A portion of the call, Greg Orenstein emphasized that even if you completely ignore the AI revolution for a moment, this fundamental shift sets them up for natural revenue expansion that they simply didn't have previously. What's fascinating here is how it upgrades the core engine of the business.
But, I mean, you can't ignore the AI revolution because the brilliant part of this strategy is how they are using AI as the carrot to force this transition.
Oh, absolutely.
CEO Sean Besman explicitly noted that if a bank wants to leverage nCino's new generative AI capabilities, they are required to adopt the new platform pricing model first.
It is a masterstroke of product positioning. The banks are desperate for the operational efficiencies of AI. And to get access, they must migrate to a business model that is structurally far superior for nCino's long-term recurring revenue.
Which transitions us perfectly to the absolute hottest topic of the earnings call. The word AI was everywhere in this transcript.
Everywhere.
But unlike many tech companies right now, nCino isn't just throwing around buzzwords to inflate their valuation. They have a concrete monetization strategy in motion right now.
Yeah, let's examine what they actually released. Just 2 weeks prior to this earnings call, nCino hosted their annual customer conference called Insight.
Okay.
Besman noted that with over 1,600 attendees, this event has really evolved from a standard software user group into a true symposium for intelligent banking. And at Insight, they unveiled their agentic operating system, or AOS, alongside a product called Banking Advisor.
Now, agentic is a term we are starting to see pop up, and we need to clarify what it means, because when most retail investors hear AI, they think of a chatbot.
Right, like ChatGPT.
Exactly. They think of typing a prompt into a text box and getting a summarized answer. But Banking Advisor is not just a glorified chatbot, is it?
No, not at all. The distinction is critical for understanding the enterprise value. A standard chatbot is strictly reactive. It waits for a human prompt, retrieves text, and stops.
Right.
An agentic system is proactive and possesses multi-step reasoning capabilities. These are purpose-built AI agents designed to execute distinct workflows. An agent doesn't just give you instructions on how to update a database. It is integrated deeply enough to take action and actually update the database on your behalf.
So how does nCino charge a bank for an AI that does actual work? Because they didn't just hike up the base subscription fee, they introduced a totally new metric called intelligence units.
Intelligence units are essentially a tokenized compute economy. Customers purchase these units to execute various AI tasks across the platform, and the pricing is dynamic based on the computational intensity of the task.
Give me an example of how that scaling works in practice. Like, what costs what?
Well, say a loan officer used the chat interface to ask a simple query. Something like, what is the current debt service coverage ratio for this specific borrower? The AI pulls the data from the database and presents it. That is a low compute task. It might cost a single intelligence unit. But suppose a risk manager deploys an agent to continuously monitor the credit performance of 1,000 commercial loans.
Oh, wow.
Right, analyzing external market data against internal covenants in the background, 24/7.
That requires serious processing power.
Exactly. Executing that complex, continuous workflow will consume a much larger volume of intelligence units. It aligns the cost directly with the computational burden.
As of the end of Q1, over 200 of nCino's customers already have their initial bundle of intelligence units. But management is executing what I look at as a classic Trojan horse strategy here. Usually, when a software company launches an AI feature, the immediate Wall Street pressure is, how much revenue is this generating this quarter?
Right, show me the money.
Yeah.
Yet Besman made it clear their near-term objective is not immediate monetization, but frictionless adoption. He explained that they deliberately and thoughtfully sized these initial bundles of intelligence units to give customers a wide runway to experiment.
Right. They calculated the bundles so that for an average bank, the free tokens should last them roughly 12 months. They want these conservative bankers to play with the AI, deploy it in real workflows, and build an absolute reliance on it.
Exactly.
Without the paralyzing fear of getting hit with an unexpected, massive overage invoice the very next month.
But the data reveals a plot twist that completely validates the power of the technology. The usage is accelerating so fast that the 12-month runway is literally evaporating. Besman revealed that usage of Banking Advisor was up 38 times in May compared to October.
38x. Let that sink in. You give a bank enough tokens to last a year, and they are blowing through the entire allocation in a matter of months.
That's wild.
During the Q&A, Ryan Tomasello from KBW asked directly about this dynamic. He wanted to know if customers were already needing to expand their allocations.
And Besman practically took a victory lap. He stated, "I'm excited to share on this call, and it is new news, that we have had our first customers reach the limit in their bundles."
Unbelievable.
He confirmed that customers are actively looking at addendums to purchase more tokens well before their renewal dates. It proves unequivocally that the AI is delivering tangible, measurable ROI that banks are willing to pay hard dollars for.
Here's where it gets really interesting. It is the ultimate free arcade model. You walk into an arcade, the owner hands you a bucket of tokens and says, "Go nuts, this should last you all afternoon."
Right.
You sit down at the most incredible racing simulator and it makes you such a better driver that you play it relentlessly. An hour later, the bucket is empty. When the owner offers you another bucket for $20, you don't hesitate. Paying for the tokens isn't a burden, it is a necessity, because you can't imagine going back to the boring analog games you were playing before.
It's a perfect analogy. Once a credit analyst realizes they can command an AI agent to instantly mass update collateral records across an entire portfolio, rather than spending 4 hours typing them manually one by one, they will never tolerate the manual process again.
Never.
They will demand the bank buys more intelligence units.
I love the strategy, but as an investor, I have to step in and challenge this. A 38 times increase in usage sets off alarm bells regarding their cost of goods sold. We know that running large language models, LLMs, is incredibly computationally expensive.
Oh, sure.
If banks are blowing through free tokens at an exponential rate, aren't nCino's underlying cloud and processing costs going to explode? Could this Trojan horse strategy actually crush their gross margins before the paid renewals even kick in?
That is the exact vulnerability investors should be probing. And honestly, the Wall Street analysts on the call hammered management on this point. Chris Kennedy from William Blair asked precisely how they are managing the cost of tokens as adoption scale.
Unrightly so.
And Michael Infante from Morgan Stanley specifically questioned the gross margin profile of these compute-intensive agentic workflows.
So how did management defend their margins?
They provided a deeply technical two-part defense. First, Desmond acknowledged the market's anxiety about AI consumption outstripping forecasts. He assured analysts that nCino has built robust internal telemetry dashboards that correlate intelligence unit consumption directly with underlying compute costs in real time.
Okay, so they're tracking it closely.
Right. He stated they are calibrating the bundles appropriately and are, quote, not too far out over our skis. And the proof is in the pudding. They achieved a 28% operating margin this quarter while absorbing these initial compute costs.
But, telemetry just tells you how much money you are losing. It doesn't actually stop the bleeding. What is the technical mechanism keeping those compute costs low in the first place?
That is where the CFO, Greg Orenstein, stepped in with a critical distinction. He explained that not all intelligence units require routing data to expensive third-party large language models like OpenAI or Anthropic.
Hold on, I want to make sure I understand this. If they aren't using LLMs for everything, what are they using?
Think of nCino's AI architecture like a hospital triage system. If you walk into an emergency room with a minor cut, you don't need the chief neurosurgeon to stitch you up.
Right. A nurse practitioner can handle it efficiently and cost-effectively.
Exactly. Similarly, nCino utilizes an ensemble of different models. For complex language generation or deep contextual reasoning, yes, they might query an expensive LLM.
The neurosurgeon.
But for analyzing risk metrics, calculating debt service coverage, or checking compliance logic against the database, nCino leverages its own proprietary quantitative models and algorithms.
Oh, interesting.
These purpose-built internal mathematical models require a fraction of the compute power compared to generating language from scratch.
Because they are just processing numbers through established banking logic, not trying to predict the next word in a sentence like a generative language model does.
Exactly. Ornstein explained that by intelligently routing tasks to the most cost-efficient compute engine, using their own math for the heavy lifting, and saving the expensive LLMs only for tasks that truly require them, they preserve their gross margins while still delivering the final outcome to the end user seamlessly.
That is a vital technical nuance for our Talk Tickers audience to grasp. Because nCino owns the proprietary models for the banking-specific math, they are heavily insulated from the ruinous API costs that plague generic, thin wrapper AI startups.
It really demonstrates deep architectural maturity and is a perfect segue into how this technological maturity is manifesting internally. Because the AI revolution isn't just a product nCino sells, it is a tool fundamentally altering how nCino operates its own business. They are drinking their own champagne.
Let's talk about the internal efficiency metrics, because the numbers shared on this call are frankly hard to believe. Let's revisit that hook from the top of the deep dive.
Yeah, let's look at those numbers again.
Sean Besman shared that in the first quarter of fiscal 2026, roughly 21% of their internal software code was written with AI assistance. Just 12 months later, in this first quarter of fiscal 2027, that percentage has surged to 57%.
Over half of the code running this global banking platform is AI generated.
Incredible.
And the translation into product velocity is profound. Desmond noted that product development cycles, which traditionally took well over a year in the enterprise software space, have compressed to under 90 days.
Wow.
He stated their engineering teams are operating approximately 34% more efficiently over the past year.
But he made a really astute philosophical point about software development on the call. He cautioned that simply writing more code is not the goal.
Wow.
The true objective is accelerating the entire product lifecycle. Because physically typing code only represents a fraction of the labor required to ship enterprise software.
Especially in banking. I mean, the majority of the friction lies in quality assurance testing, rigorous security reviews, vulnerability scanning, and compliance validation.
Exactly.
If an AI can not only write the code, but automatically generate the testing frameworks and validate the security protocols, that is where the 90-day cycle becomes a reality.
And this efficiency is bleeding out of the engineering department and directly into their professional services organization.
Yes, it is.
For those unfamiliar, professional services refers to the consultants and implementation specialists responsible for actually installing and configuring the nCino software inside a client bank. Desmond revealed they have built internal AI tooling that has compressed the professional services hours required per engagement by over 40%.
A 40% reduction in implementation time is a monumental leap, and you can see the financial impact clearly. Greg Ornstein reported that non-GAAP professional services gross margin expanded by 1,100 basis points year over year, hitting 10% in Q1.
That's massive.
That margin expansion alone contributed roughly $1 million to their operating income outperformance.
But Desmond argued, the real victory isn't the immediate margin bump. The broader strategic victory is that shorter implementations radically alter the sales dynamic.
How so?
Well, if a regional bank knows that a legacy software migration will take 18 months of agonizing disruption, they might postpone the decision forever. But if nCino can promise they will be up and running in a matter of weeks, the friction to sign the contract just evaporates. Lower program costs for the banks drive higher pipeline conversions for nCino.
To execute these rapid deployments, nCino utilizes specialized teams they call Forward Deploy Engineers, or FDEs. While Desmond joked that it's just a fancy title for consultants, their methodology is highly effective.
Right.
These are highly technical elite implementation engineers who sit side by side with the bankers on site, observing their actual daily friction points and deploying AI solutions in real time.
We have a brilliant case study of this from the transcript. Desmond highlighted Connect One Bank, which is a $14 billion institution operating in the Northeast. Connect One's CEO, Frank Sorrentino, actually shared the stage with Desmond at the recent Insight conference.
And Sorrentino laid out an objective that is the holy grail for any bank executive. He stated his goal is to reclaim 50% of his team's time.
You say percent?
He wants to take the hours they spend on tedious manual data entry and redeploy that human capital entirely toward revenue-generating activities, like building relationships and structuring deals.
And 50% time reclamation is an incredibly aggressive target. How are they actually doing it?
Connect One engaged nCino's Forward Deploy engineers back in March for a targeted, quick-win engagement. The FDEs assessed the bank's current benchmarks, pinpointed the most painful workflow bottlenecks, and deployed specific AI agents. The results were immediate. Desmond reported that Connect One's credit analyst agent is already delivering 60% more efficiency on credit reviews.
Let's give the listener a tangible example of what that looks like on the banking floor. Instead of a banker manually searching for entity data to create a new commercial relationship record, they simply instruct Banking Advisor to do it.
Right.
Instead of the grueling one-by-one process of cross-referencing and updating collateral records for a real estate portfolio, the AI agent executes the updates en masse. The FDEs integrated these capabilities into the daily habits of the users in just weeks.
If we connect this to the bigger picture, it illuminates the ultimate defensive barrier nCino possesses. In the technology sector, investors obsess over moats, right? The structural advantages that protect a company from competitors. The natural question is, why won't a heavily funded generic AI startup out of Silicon Valley just build a clever banking chatbot and steal nCino's entire client base?
This is the crux of the bull thesis. Let's define the moat.
The moat is constructed from two inseparable elements: proprietary historical data and absolute regulatory trust. Desmond was emphatic on this point. nCino's AI capabilities aren't just trained on the open internet, they are shaped by nearly 15 years of operational, highly specific banking data.
Right.
This is workflow data, from global megabanks down to community credit unions, capturing exactly how complex commercial loans are structured, how risk covenants are monitored, and how compliance is enforced across thousands of unique edge cases.
A Silicon Valley startup simply cannot scrape the internet to learn how a regional bank in Ohio underwrites a customized agricultural loan. That data lives exclusively inside nCino's servers.
Exactly. And the second half of the mode is the regulatory environment. Desmond delivered a quote that should be framed on the wall of every fintech investor. He said, "In banking, intelligence without accountability isn't intelligence, it's a liability."
That is a phenomenal point. If an AI hallucinates a recipe for chocolate chip cookies, it's funny. If an AI hallucinates a credit score or skips a KYC compliance check on a multi-million-dollar commercial loan, the bank faces massive federal fines, reputational destruction, and potential systemic exposure.
A bank cannot tolerate a black box AI. nCino has built its architecture to ensure that every single AI interaction on the platform is auditable, traceable, and governed by the exact same stringent permissions and access controls that a human employee is subject to. A general-purpose AI provider cannot reverse engineer 15 years of regulatory compliance architecture overnight.
It is an impenetrable barrier to entry. General AI companies will build the foundational models, but deeply embedded vertical software companies like nCino will capture the enterprise value because they control the workflow and the trust.
Absolutely.
However, as TalkTickers investors, we cannot simply cheerlead the AI narrative. We have a mandate to evaluate the entire business. And while the future looks like a sci-fi utopia, the present macroeconomic reality presents a distinctly split screen.
It is a tale of two very different markets. The earnings report revealed stark geographic and sector divergences. Let's begin with the tailwinds. The international business is booming. Non-US subscription revenue grew 21% year over year.
That's great.
If you adjust for foreign exchange fluctuations and look at it on a constant currency basis, it is still an incredibly strong 16% growth rate.
Analyst Charles Navin from Stephens specifically dug into this during the Q&A. Where is this international momentum originating?
Desmond pointed to substantial pipeline acceleration across continental Europe, Japan, and Southeast Asia. He noted a strategic shift. Historically, their European strength was concentrated in the UK and Ireland, but now he is spending considerably more executive time on the continent.
Okay.
They've installed new regional leadership who have invigorated the sales force. Interestingly, the demand in Europe right now is heavily indexed toward onboarding solutions and full client lifecycle management, as those institutions scramble to modernize their disjointed legacy systems.
So the international segment is providing a robust growth engine. But then we pivot to the domestic U.S. mortgage segment, and the temperature drops dramatically.
Yeah, it does.
U.S. mortgage subscription revenue came in at $19.7 million for the quarter. That is up 4% year over year, which seems anemic but stable. However, it is the forward guidance that tells the real story. Management is forecasting a 2% year-over-year contraction for U.S. mortgage revenue in the second quarter.
We need to unpack the mechanics of the U.S. mortgage market to understand why nCino is facing this headwind. This is entirely driven by the macroeconomic environment, specifically the Federal Reserve's interest rate policy. Elevated rates hovering around 7% have effectively frozen the housing market.
Let's explain the lock-in effect for the listener. During the pandemic, millions of homeowners refinanced or bought homes locking in 30-year fixed mortgages at roughly 3%. Today, if that homeowner wants to move to a slightly larger house, they would have to trade their 3% mortgage for a 7% mortgage, doubling their monthly payment for the exact same loan amount.
Consequently, nobody is selling their homes unless absolutely forced to by life events. This means new purchase origination volume has plummeted. Furthermore, the refinancing market is essentially dead. I mean, you wouldn't refinance from 3% to 7%, right?
Exactly. And because nCino's mortgage software revenue is highly correlated to origination volume, they get paid based on the velocity of loans moving through the system. This industry-wide deep freeze directly impacts their top line.
I know the skeptical investor might ask, is nCino simply using the macro environment as a convenient scapegoat? Are they actually losing market share to competitors like Encompass or Specialized Point Solutions because their mortgage product is inferior?
It is the first question that pops into my head when a CEO blames the macro.
It is a necessary question, but cross-referencing nCino's numbers with broader industry data suggests the excuse is totally valid. Mortgage Bankers Association data confirms that overall origination volumes are near historic lows. The drag is genuinely systemic. What is more important for retail investors to evaluate is how management is communicating this reality in their financial forecasts.
This is where I actually give management a lot of credit. They are operating with extreme prudence. CFO Greg Ornstein explicitly stated that their guidance models assume absolutely zero macroeconomic recovery for the remainder of the year.
It is a highly conservative posture. There are industry economists projecting potential rate cuts in the back half of the year, which could theoretically thaw the market. But nCino's refusing to bake that hope into their numbers.
As an investor, you have to respect the discipline. They are systematically de-risking their guidance. They aren't promising a magical intervention by the Federal Reserve to save their quarter.
Right.
By setting the baseline at no recovery, they protect the downside. If rates do happen to drop and volume unexpectedly surges, that revenue becomes pure upside surprise, generating a classic beat rather than scrambling to explain a missed expectation.
Precisely. And this philosophy of conservative forecasting transitions us smoothly into the most critical segment for institutional investors, and the sixth pillar of our analysis, management guidance. What exactly are they promising the street for the rest of fiscal 2027?
Well, despite the mortgage headwinds, the aggregate narrative is highly positive. nCino raised their full-year guidance across every major metric. Total revenue expectations were bumped to a range of $642 million to $646 million, representing roughly 8% growth.
Nice.
Subscription revenue, the metric that truly matters, was raised to a range of $571.5 million to $575 million, maintaining approximately 10% growth.
Once again, the profitability metrics steal the show. They raised their non-GAAP operating income expectation to a robust range of $166 million to $171 million. That represents a 30% increase over their fiscal 2026 performance.
However, there is a subtle accounting nuance here that separates the amateur transcript readers from the seasoned analysts. While they raised the full-year operating income guidance, they deliberately did not pass through the entirety of their massive Q1 outperformance into that full-year number.
This is a classic setup. They crushed Q1 profitability estimates, but only raised the annual forecast by a fraction of that beat. Why hold the rest in reserve?
Did Ornstein explain the rationale behind suppressing the full-year number?
He provided two specific reasons. First, there is a tangible shift in the timing of their marketing expenses. Specifically, the heavy costs associated with executing their large-scale Insight Customer Conference shifted out of the first quarter and will hit the books in the second quarter.
Ah, okay.
Consequently, he noted they need to account for a roughly $3 million sequential increase in sales and marketing expense.
So that is just basic expense tracking. What was the second reason?
The second reason is purely strategic. He emphasized a desire to maintain operational flexibility at this relatively early stage in the fiscal year. By holding back some of that outperformance buffer, management ensures they have the dry powder to invest aggressively in new AI initiatives if an opportunity presents itself, or to weather unexpected macroeconomic turbulence without jeopardizing their commitment to Wall Street.
So what does this all mean? We put on our talk tickers hats. What does this guidance strategy actually mean for the stock?
It indicates we are observing a textbook beat-and-raise maneuver executed with maximum conservatism. They are fundamentally under-promising in order to over-deliver later.
Right.
By retaining a buffer, they construct a highly favorable risk-reward scenario for the rest of the year. If the economy deteriorates, that buffer absorbs the shock, and they still meet their lowered bar. If the economy remains stable, they are positioned to continually hurdle estimates quarter after quarter.
It minimizes the downside cliff while preserving the upside momentum, which tees us up perfectly for our final section, the bottom line. This is where we aggregate the data, the pricing pivots, the AI Trojan horse, and the macro crosswinds to deliver a definitive verdict. Based on this Q1 transcript, are we fundamentally bullish or bearish on nCino?
When you synthesize the operational realities, the acceleration in subscription revenue, the dramatic leap in operating margin to fulfill the Rule of 40, the aggressive deployment of a $93 million share buyback at a $15.20 valuation, and the structural brilliance of forcing the platform pricing transition, the inescapable conclusion has to be bullish.
I lean the exact same way. Let's synthesize this into an actionable thesis for the listener who is evaluating their portfolio. The narrative is dual-layered. Layer 1 is the foundational business. The traditional software plumbing that nCino provides to the banking sector is highly sticky, deeply entrenched, and now highly profitable. They are generating substantial free cash flow, and management's decision to utilize accelerated share repurchases signals they view their current valuation as disconnected from their intrinsic worth. That alone constructs a reasonable investment thesis.
But layer 2 is where the true alpha resides. The reason this stock demands rigorous attention is the asymmetric upside of the artificial intelligence component. Consider this. The current financial guidance predicting 10% subscription growth and up to $171 million in operating income does not model in any meaningful revenue from AI intelligence unit consumption.
That is the coiled spring.
Precisely. Management has explicitly stated their FY27 priority is frictionless adoption, giving away enough free tokens to get banks addicted to the workflow. But the data shows the addiction is taking hold faster than anyone modeled. Usage is up 38 times. Customers are exhausting a 12-month token allocation in a single quarter.
When those initial bundles expire, and these massive financial institutions are forced to sign addendums to purchase millions of intelligence units just to maintain their new operational baseline, that revenue carries incredibly high margins and drops straight to the top line. It represents a massive coiled spring of revenue expansion poised to release in fiscal 2028 and beyond.
This raises an important question, though, for the broader banking sector. We can clearly see that nCino is technologically positioned to capture this value. But we have to ask, how quickly will these traditional conservative compliance-obsessed banks fully submit to these proactive agentic workflows?
That is the ultimate friction point. Wall Street analyst Aaron Kimson astutely compared this to the years-long agonizing struggle of convincing banks to migrate their data from physical basement servers to the public cloud. There's a profound psychological trepidation among bankers to let software make autonomous decisions.
The hesitation is real, but the usage data suggests the tipping point might have already arrived. Return to the Connect One Bank example. If CEO Frank Sorrentino successfully reclaims 50% of his team's time and redeploys it to writing new loans, the competitive dynamics change instantly.
Right. If the bank across the street refuses to adopt AI because they are scared of the cloud, they will be paying 5 analysts to do the work of one nCino agent. They simply will not be able to compete on efficiency or cost of capital.
No, they won't.
They will be outmaneuvered, the margins will compress, and they will eventually be acquired by the modernized bank. The fear of missing out is powerful, but the fear of operational obsolescence will drive AI adoption through the banking sector much faster than historical software trends suggest.
And that concept leads us to a much larger, almost philosophical implication regarding the future of finance.
Let's hear it.
If nCino's platform can successfully deploy AI agents to execute continuous portfolio monitoring, if these agents can dynamically evaluate complex debt service covenants in real time, and if they can entirely eliminate the manual data entry drudgery of commercial loan origination, does this technology fundamentally democratize the banking industry?
Let me stop and think about the mechanics of that.
Think about a small community credit union in the Midwest. Historically, they could never compete with the trillion-dollar Wall Street megabanks for complex, syndicated commercial real estate deals.
Sure.
Not because they didn't have the capital to lend, but because they simply couldn't afford the army of highly paid risk analysts required to underwrite and continuously monitor the compliance of that specific collateral.
But if nCino's software provides that exact same credit union with an AI agent capable of executing the analytical workload of 10 senior analysts for the fractional cost of a few intelligence units, suddenly that small institution possesses the identical operational firepower as a global behemoth.
Exactly. It levels the operational playing field. It transforms risk analysis from a human capital advantage into a commoditized software output.
That is a staggering thought to end on. It suggests we aren't just evaluating whether nCino can hit 10% revenue growth next year. We are evaluating a company that is actively shifting the competitive architecture of the entire financial sector. So we turn it back to you, the listener. What stands out to you from this deep dive? Is it the astonishing reality that 57% of nCino's underlying code is now being authored by artificial intelligence? Or is it the strategic brilliance of giving away a year's worth of AI compute tokens only to watch customers burn through them in a matter of months? We want to know where you see the true, durable value in this narrative.
Because, as we have demonstrated today, true investing knowledge requires more than just skimming the headline revenue numbers on a press release. It requires understanding the deep structural workflows, the technological architecture, and the human behavioral shifts that drive those numbers long into the future.
When we started this deep dive, we talked about how a typical earnings transcript reads like a dry, sanitized instruction manual. But when you know what to look for, when you understand the mechanical leverage of accelerated share repurchases, the strategic necessity of asset-based pricing, and the exponential trajectory of intelligence units, that dry manual transforms into a blueprint for the future of finance. Thank you for joining us as we unpack this blueprint today. Keep diving deep, keep questioning the underlying mechanics, and we will see you on the next one.